Good morning, Michael Shotnick, branch manager of Sierra Pacific Mortgage. Wanted to check in and touch on a subject that's kind of top of mind right now. Interest rates are increasing, and there's a lot of confusion as to why. It's fairly simple once you kind of understand a few basic details, kind of how rates fluctuate and the cost of money increases. The Federal Reserve, so the Fed, controls a few different aspects of money and the cost of borrowing money. The Fed funds rate is referred to as prime and is actively discussed in the financial markets, and it's the rate at which banks borrow short-term money. So credit cards, home equity lines of credit, so adjustable rate financing is tied to the Fed funds rate. So when the Fed raises rates 0.25%, or that's kind of an increment they like to use and have over the past kind of year here and will moving forward. When they raise the Fed funds rate 0.25%, what it does is it increases lines of credit, credit cards, that short-term debt. Doesn't directly impact long-term mortgage rates. So a 30-year, 20-year, 15, 10-year loan is tied to a different financial instrument called a mortgage-backed security. This mortgage-backed security is traded and controlled completely different. It's its own bond market, and the bonds are bought and sold in a different manner than the Fed funds rate is controlled. So the bond market is a bit more complicated in that not one entity controls the price of each given bond. The Fed has kind of manipulated the market by buying a substantial amount of bonds, and what has happened is the supply of the bonds has been reduced because the Fed is buying so many, and that's basically holding rates down. The Fed is now tapering down the amount of bonds that they buy. So what that's doing is taking a really big purchaser out of the market and creating more supply, less demand, and worsening rates. As rates increase, the yield on each bond, so the revenue produced by each bond also decreases, so they become less attractive to not just the Fed, but all the other players in the industry. So fundamentally, with the Fed buying less of these bonds, which again dictate mortgage rates, rates are increasing, and it's not a matter of if, it's just kind of how much they will as the Fed decides to buy less and less of these bonds. So we do anticipate that rates will continue to increase through the end of 2018. The Fed is scheduled to substantially reduce the amount of these bonds that they're buying, which is going to push rates up. There will hopefully be more demand via private investors and in foreign countries buying these bonds that will hopefully pick up some of the slack. But as these yields are kind of minimized, we may not see a rush, but we will stabilize eventually here and get to kind of a normal market, which we're all looking forward to, even though rates may be a tad bit higher. Michael Shotnick, Sierra Pacific Mortgage. If I can help you, you can reach me at 303-800-4595, extension 3. Thank you.